Efectivamente, para el cierre de este 2024 y ya echando el vistazo al 2025. Vamos a poner, bueno, esas perspectivas para la renta variable. Saludamos ya a Teresa Keane, Product Director at AllianceBernstein. Thank you very much for being with us today.
Thank you. Good afternoon.
It has been a strong year for equities looking at the year-to-date returns. Can you comment on that?
Yes, of course. So good afternoon, everyone. So yes, as we come to the end of the year and we're almost there, certainly equities have performed very strongly this year. And if we look at the returns for global equities in particular, they have delivered almost 22% over the period January through the end of November. And then US equities as a whole are also up very strongly, up almost 28% in US dollars. So then looking at the chart on the left-hand side, and in particular the period, the rising market period, following the significant drawdowns from the end of September 2022, all the way through to today, you can see that global equities have actually delivered a very strong cumulative return of 65%. US equities also have delivered a very strong cumulative return of over 70%. However, having said that, it hasn't all just been rosy. Investors have had to contend with many risks along the way, from inflation rates and, of course, the ongoing geopolitical risk, and then, of course, the market concentration. And you can see some of that being reflected on the right-hand side of the chart, where I'm showing sector returns for global equities. And in that first half of the year, from January to June, you can see in particular that technology and communication services were strongly outperforming and really driving returns. And then in that second half of the market, we've seen a reversal. So we saw volatility rise going into that third quarter to levels not seen since 2022. And really what happened there, much of the instability was driven by weak news coming out of the US. And of course, at that time, we also experienced the unwinding of the yen carry trade. So there were many risks coming out of the market at that time. The Fed at the same time actually did announce aggressive rate cuts, and that did reassure investors that inflation could be tamed and that the US economy was not necessarily going to dip into recession territory. So you can see a reversal, as I said, in that second half of the year from July all the way through the end of October, with real estate and utilities driving returns. And of course, these are the sectors and industries that are well known for interest rate sensitivity. So over the year as a whole, equities have performed strongly and growth is performing strongly year to date. Only we've had significant risks along the way. And we expect, of course, that to continue into next year. The good news is we have also seen a broadening of the market away from the significant concentration in the market that we had in 2023 and also moving into 2024 as investors are starting to focus on fundamentals as a whole.
You have spoken about the investors, but since one of the most important moments of this year, the US election, what are some of the key concerns of the questions coming from your clients?
Well, that's a very good question. I mean, to be honest, some of the questions that are coming from clients is really concern with regards to the policy areas that are likely to be impacted by the US election. And looking at a recent survey which has come out, trade and in particular trade restrictions have really been highlighted. And then and of course, if that is the case, of course, trade restrictions means slower growth, and it also has the likelihood of pushing up prices. Of course, this macroeconomic environment is quite different from the last time that tariffs were introduced back in 2018. We're now in an environment where fiscal policy is much worse. Of course, inflation is not dead. And of course, valuations are higher as well. So a very different macroeconomic environment today from what we were dealing with the first time around. So in terms of inflation and coming back to inflation and how are we managing that? And in terms of equities, what we would say, and our research showcases, and this is research over the last 100 years, And when inflation has been running approximately between 2 and 4%, equities have delivered real returns. So equities have been an effective inflation hedge against those price increases. And when inflation has run between 0 and 2%, equities have delivered approximately 11% over such periods. So equities as a whole have delivered during those periods and is an effective inflation hedge against those price increases. And we need equities, of course, in order to deliver that long-term return and those financial goals for our clients as a whole.
And Teresa, what are valuations looking like for the Mag 7?
Well, in terms of the Mag 7 and valuations, of course, valuation discipline has been really important for a strategy such as the one that I'm speaking to today. In terms of valuations for the Mag 7, they've come down a lot, really, from June. In June, we're looking at premiums of around 75%. If we look at the price to forward earnings, the current premium right now is around 47%, so much lower than what it was coming down from those peak valuations earlier in the year. The 10-year average is around 37%, so they're still high. Valuation is still a key risk in the marketplace today. And then looking out over the next 12 months, if we look at the price to earnings ratio, what we're seeing in terms of non-US stocks is that they're actually trading at a significant discount of around 36% relative to the US market. That average discount is usually around 21%. Of course, risk management is really important to us in these types of environment. And when we designed this strategy, that's exactly what we were thinking of in terms of delivering on that long-term objective of outperforming the market with less risk. So when we think about risk, we think about risk through three lenses. First of all, market risk. We care about absolute loss. We're seeking to deliver on that superior risk-adjusted return over time for our clients. In terms of factor risk, we maintain consistent exposure to quality, stability, and price. And I've talked about that many times. So in terms of quality, we're looking for these companies with consistent cash flow, measures of profitability like return on invested capital. And then in terms of stability, we're looking for those names that are less susceptible to that wide market risk. And then in terms of price will always be important because we're seeking to avoid that crowded trade. Of course, in times like this, that's very important. Valuation discipline is always important. And then the third lens is idiosyncratic risk. We're relying on our fundamental analysis to identify any risk that may be coming down the pipeline on any stock in the future. So we're maintaining that discipline, our consistent exposure to quality, stability, and price in order to deliver on that long-term return over time for our clients. Valuations are coming down. They have come down for the Magnificent Seven, but clearly that valuation discipline is very important in today's market.
And to the end, Teresa, what are the valuations? What is your outlook going into this year, 2025?
Well, I think in terms of outlook for the rest of the year, we're certainly expecting to see some greater divergence between economic and policies globally. We are expecting to see inflation normalize at higher levels than we have seen in the past 10 years. So although inflation has come down, it's likely to normalize at those higher levels. We may even expect to see some inflation volatility going forward. So the chart that I have on the left-hand side really showcases, I think it's an interesting chart. It showcases returns over time for the US equity market if you had invested during a Republican presidency or during a Democrat presidency. What the point is here is I'm advocating to stay in the market at all times. And really, that's what we were doing when we designed this strategy, enabling investors to stay invested in the market during periods like this. As I mentioned earlier at the beginning, investors have had to contend with numerous risks along the way, even since the end of 2021. 22 over 23 and today's market. And so in order to achieve that, we really are relying on our bottom-up fundamental research to deliver on that long-term return over time for our clients by investing in quality, stability and price. We do know that the next 10 years is not going to be anything similar to the last 10 years. And in terms of how QSP has performed over these periods and in a modestly rising market environment, in an environment where equities is between 0 and 10%, you can see that QSP does actually deliver over and above that. Now, in a significantly rising market environment, such as the one we've been in an environment which has been really concentrated, we will lag the market because actually we have a beta of 0.8 to 0.85. Over time, we are seeking to deliver that long-term return with less risk, but also an uncorrelated pattern of return, that smoother journey along the way.
Thank you very much, Teresa. We will continue pending these conclusions that you bring us here.
Thank you very, very much. And
thank you very much.
Have a wonderful Christmas. Thank you. Bye-bye.